Have you ever entered a trade feeling confident only for the market to humble you instantly? You saw a breakout, you entered and boom, stop loss. Let me ask you honestly, have you been trading the market or has the market been trading you? Today, I will explain breakout structure in the simplest way possible. Even if you have never traded before, this will finally make sense. Quick question. Are you a beginner or intermediate trader? Comment below. Before we get it started, if you are a struggling trader, tired of losing trades, tired of trying everything with no results, don't quit yet. Don't quit. You don't have to do this alone. If you want mentorship and structure, join the ChartsEmpire VIP community. If you just want powerful trading signals, check the links in the description of this video. There is something there for you. Please take your time to check it out. It is time we get started with this tutorial on breakup structure, BOS. So, what is breakup structure? For us to identify breakout structure, we need to make references to the types of market structure we have in technical analysis. We were being told at the beginning of your trading course that price can move in 4 different ways. We have the bullish market structure like this, whereby price keeps on making series of higher highs and higher lows. We told you whenever you see this, it means price is going in an uptrend market structure or bullish market structure. We said the opposite is a downtrend market structure, whereby market goes like this, keeps on giving us lower low and lower highs. Whenever you see this market structure, it means price is in a downtrend market structure. And the third market structure is what we call the sideways market structure, which is like this. We told you price is bouncing through a medium and we have equal highs and equal lows. So this is sideways market structure. Fortunately, we don't have any break of any structure right here. If you don't understand that by now, don't worry. By the time I give explanation on bullish market structure and bearish market structure, the breaks right here, you understand why we don't have breakout structure on the sideways market structure. And the third market structure is the choppy market structure, whereby you don't know where the market is going. Maybe it's going down or market cost keeps on moving wherever it wants. So we told you to ignore this type of market structure. So you focus on uptrend, downtrend, and sideways. But for us to experience a breakout structure can occur in 2 types of market structural formation, which are the uptrend market structure and the downtrend market structure. Now, let's see how breakout structure can occur in an uptrend market structure or a bullish market structure. First thing, we have breakout structure. We have a high and then a higher low. At first, we don't know maybe this is going to be a higher low until when price takes out the recent highs right here. When price takes it out, then we have a higher low, then we have a low right here, and the price keeps on giving us highs and then higher lows and then higher highs and then higher lows and then higher highs. Now, for us to have a higher highs or a rising highs in a market, then there has to be a breakout structure. Now, take note of these highs we have in this market right here. You can see these highs, all these highs, and then all these highs, and then you can see these lows. These lows are the bottoms, the lows are the bottoms, the lows are the bottoms. Now, the lows at the bottoms are what we call the higher lows, and the low and the highs or the peak at the top is what we call the higher highs. Now, for us to have a higher high, we need to break a structure. We need to break a structure to the upside. Now, you can see at this point right here, price went through this level, took out this level, that is this peak right here, and then to the upside, which means this peak right here is now higher than the previous peak right here. Now, for this to occur, it means there is a break of this high, which we call breakout structure. So this is where the word breakout structure was being originated. You can see that. So this is the breakout structure right here. We broke this high. This is what we call breakout structure. And you can see the repetition right here. We went high again, took out this high, and then you can see that. Then we kept on having what? More breakout structure. You can see that. And again, price went up to take out this highs again right here. Then we have another what? Breakout structure. So in an uptrend market structure, price will keep on taking highs out to give us a new higher high, and then once that occurs, then that is what we call a break of a previous high. This is what we call breakout structure. Now let's study what we have underneath this market move. You can see at the bottom, price was giving us higher lows without coming all the way down. So that means underneath the price right here, we didn't have any breakout structure. Price is just going up. So it means in a bullish market structure, our breakout structure will occur at the top, takes out a recent high to give us a new higher high. That is it in a bullish market structure. Now let's study for a bearish market structure. For a bearish market structure, price moves down, give us a low, then moves up, then turns down, give us a low high, then lower low, then price keeps on repeating this movement all the way down. This is what we call a bearish market structure. Now underneath it, we have a breakout structure. We can see this low right here. Price went through at this medium, whereby taking out or breaking this low. This is what we call breakout structure. Right here, it takes out this low, this breakout structure, and the right here, it takes out this low. This is breakout structure. So simple as ABC. Whenever price takes out a low or closes below a previous low, we have a breakout structure to the downside. Now you can see again right here, it takes out this low, we have more breakout structure to the downside, and then again we have another break to the downside. So this is how breakout structure occurs in a downtrend. You can see at the top, we haven't seen price taking out this highs. Instead, price keeps on going more deeper and deeper. So this is what we call a bearish breakout structure in a downtrend. So in a downtrend, price will keep on taking out or breaking previous lows or lower lows to give us new breakout structure. And this indicates more sell to come, or the sell is still going on in such trend. So this is what we mean as breakout structure in a downtrend. Now that we've known breakout structure in an uptrend and in a downtrend, now let's see why there is no breakout structure in a sideways market structure. Now, based on the understanding we had on breakout structure, we told you breakout structure are to take a highs or a lows. Now let's see this market movement right here. What can we see? We can see price keeps on passing through the same equidistance. You can see right here, we didn't have any break right here. Instead, price was just bouncing to a medium. So this is why we say a breakout structure is not common in a sideways market structure, or it's not reliable. But at times, price can give you break right here. It's not a break, it's a force or a fade in the breakout or sweep or liquidity grabs, which I explain some of this concept in my Yoruba YouTube channel, so you can check that, and as well have the videos on my English channel. You can check the links in the description of this video. If I forget to put the link in the description, you can just comment, oh please send us the link, or please put the link to the video on liquidity grab and liquidity sweep. So right here, it's a sideways market structure, so we necessarily don't need breakout structure, or breakout structure is irrelevant or not reliable in a sideways market structure. So for us to trade a reliable real breakout structure, we look out for bullish market or bearish market structure. Now let's go through risk chart examples and look out for breakout structure. Now, as you can see on this market price right here, you can see from these lows right here, we had a highs. Price took out this level right here, so this is a breakout structure. You can see we had a breakout structure to the upside right here, and then again price went all the way from this level right here. We broke this level to the upside, so this is a breakout structure right here. You can see that, and again price went up, took out this structure right here, so this is a breakout structure right here. And currently right now, price is here to take out this high. And then before we move to this high right here, let's study what we had at these previous lows. You can see we have higher lows and a higher lows. And then at this structure right here, you can see our price broke this level. Price broke it, but price later swept it all the way up before it comes down. Now, at this mediums right here, you can see we had some breakout structure to the downside, just as the example I gave you in the downtrend market structure. Now, in the downtrend market structure, you can see we have a lows right here. Price took out this low for a more downtrend. You can see that. So we broke this level right here for a more downward push, which is a breakout structure or a bearish breakout structure. And this medium right here, we broke it to the downside, which is also a bearish breakout structure. So it's so simple to identify a breakout structure to the downside. We take out a recent lower low, and a breakout structure to the upside, we take out a recent higher highs. So this is how breakout structures moves in the market. So this is not all. There is still more to breakout structure. As we keep on progressing, you will tend to learn some other technical terms, which are change of character, MSS, market structural shift, and the SOS, switch of structure. So for now, just know when a recent high is taken out, it means breakout structure to the upside, and when a recent low is taken out for more lower low, then it means breakout structure to the downside. So yes, this is what we call breakout structure. Let's keep this simple. Breakout structure means the market has changed directions. In an uptrend market structure, price makes higher highs and higher lows. In a downtrend market structure, price makes lower lows and lower highs. The moment price breaks a previous high or low with strength, that is called breakout structure. Think of it like someone walking forward, then suddenly turning back aggressively. That shift matters because it often means big money stepped into the market. Tell me honestly, is this your first time understanding BOS clearly? Let me know in the comment box. Now, why does breakout structure BOS matters in trading? Most beginners lose money because they trade without confirmation. Breakout structure gives confirmation. It shows directions, strength, intent. Institutions don't trade randomly. So when structure breaks clearly, something serious has happened. And when you follow structure instead of emotions, trading becomes calmer. Be honest, do you enter trade with confirmation or emotions? Let me know in the comment box. So as a trader, how can we identify real BOS, breakout structure? Here is how beginners should identify a real breakout structure. First, identify the trend clearly. Second, mark the most recent high or low. Third, wait for a candle close beyond that level, not just a week. Fourth, look for strong momentum. So the first thing you want to do is you want to identify the trend clearly. As you can see right now on this chart, we can see the chart is bullish. So we already know, okay, we are in a bullish market structure. You can see how market keeps on going up, higher low, higher high, higher low, higher high, higher low, and the higher high, higher low, higher high, higher low, higher high, higher low, and the higher high. So we already know that this is a bullish market structure. Now that we've identified the trend, the next thing is to mark the recent highs and lows. Now, in the bullish market structure, we want to mark the recent highs. Now, as you can see right here, let's start from these highs. This is the high, which is the higher high. You can see our price broke it up. Now, this is our breakup structure, right? So we can say, okay, we have a, let's zoom in big. Now we have a breakup structure right here, BOS. Now we place this BOS right here. Now the next thing we need to do is to continue marking the recent highs in this market to see how price keeps on giving us breakup structure. Now we broke this level right here. This is not a definitely breakup structure, but we can just put it right here as a breakup structure. So we have another breakup structure right here. You can see that. So this is how we continue to mark our breakup structure to the upside. We broke another structure right here, so that is another breakup structure. Okay, so we move on. We have another breakup structure right here. We broke this level right here, and we move all the way higher again for another break, and we continue. We mark another highs right here. We broke this structure. Now we have our breakup structure. You can see how market keeps on going all the way up. So we can put this breakup structure. It ends at this level because price actually later reversed from these zones right there. So as you can see, we can see how market keeps on giving us breakup structure to the upside. And right here we have a breakup structure right here. So we have a breakup structure. This is a breakup structure. So that is the second step. You identified the recent high in a bullish market structure. And for a downtrend market structure, we need to identify the recent lows. Now let's look at for a bearish market structure. Okay, we have a good structure right there. Now what we want to do is we want to identify a recent low. This is a low right here. Okay, so we have our breakout structure right here, which are BOS. You can see that. So that is our breakout structure, and all the way down we have another break right here. So this another breakout structure, and as the market moves all the way down, we have another breakout structure right here. You can see that. Now here comes another breakout structure. You can see that breakout structure, and as the market keeps on going all the way lower, we keep on having internal breakout structure. So this is how we identify our breakout structure. Right now, the third step is to wait for a candle close beyond that level. Now let's go back to our bullish market structure. Now let's study these examples right here. Now you can see what we have right here. There is a level right here, breakout structure. Now we have a breakout structure right here, BOS. You can see price took out this level with this candlestick. You can see our price rallied all the way up, and we have another breakout structure right here. You can see that structure. Price took out this structure, we rallied up, we came back again to test it, and then continuation to the upside. We broke out this level once again, breakout structure. You can see how the market continue up. Now let's study what happened right there. You can see the breakout we had right here was a very long bullish candlestick. When compared to this one right here, it was a kind of very medium candlestick with an upper shadow. But the type of bullish breakout we had right here was a very long one. And then if you still remember what we taught you under the candlestick pattern in the beginning of your trading career, we taught you what is called the Marubozu candlestick. You can see a bullish Marubozu candlestick is what broke out this structure right there. You can see when price broke out, price went far before it retraced. You can see that. So this is how we identify our breakout structure, and the price keeps on going. You can see how price keeps on validating all this structure to the upside, breakout structure to the upside, and right here we have a breakout structure to the upside, and right here we have breakout structure. You can see how this trend keeps on going all the way higher. Now in a downtrend we have the reverse, we have the inverse case. So in a downtrend you can see what we have right here. Price break out this level, price need to take out this level, takes it out, not with a wick. You can see we don't have a wick right here. We have a bearish Marubozu candlestick right there. Price rallied again. We took out this low with a candlestick. Even though we had a wick right here, the body of this candlestick closed below this low right here. You can see that. And then all the way down we have another breakout structure. In fact, we had another breakout structure right here. You can see how this candlestick took out this low. We didn't have a wick right here. You can see our candle close below the structure. Now all the way low we have another break right here. You can see our price kept on going all the way down. So these are the 3 steps you need to figure out, which are: first, identify the trend clearly; second, mark the most recent high for a bullish rally, and for a bearish rally, mark the recent low; and third, wait for a candle close, a strong candlestick without upper shadow or lower shadow, taking out the level based on direction of the momentum. And the fourth, look for strong momentum. Volume is essential if you want a breakout, which I explained earlier. A low volume or a low momentum means there's a higher tendency for price to retrace back. But whenever you see a kind of a very strong candlestick without upper shadow or lower shadow, then it means there's a higher tendency for the breakout to continue to the downside. So that is what we have under the breakout structure, retest, breakout structure. All right, so a real breakout structure is confident. A real breakout structure is confident, not shy, not weak. In a place whereby you see a weak candlestick, a shy candlestick, then it's tendency price will fail. Now let's check out fake breakout structure. Let's check out fake breakout structure. If we know the characteristics that makes a real breakout structure, then let's find out a fake breakout structure. A real breakout structure is confident, not weak and not Chai. Quick one. Have you been entering on wicks instead of candle closes? Let me know in the comment section. So, how can we identify fake BOS on the chart? Now, this part is important. Fake breakup structure is where most beginners lose money. A fake BOS or breakup structure usually has long wicks, low volume, no follow through. Institutions use fake breaks to trap impatient traders. Yes, if you rush entries, the market will teach you patience the hard way. Now, as you can see right here in this downtrend, when price broke out of this high here, now let's carefully study the volume we had right here. You can see it was a strong volume with strong momentum. You can see that. You can see this is a bullish Marubozu. This is strong volume or high or strong momentum. Now let's figure out what happened at these highs once again. As you can see on this high, we also have a strong volume candlestick, which you can see how price went in aggressively, went out that level. And again, you can see right here how price kept on moving aggressively. You can see that momentum, strong volume, bullish candlestick goes up. Now let's study what we had right here. From this level here, we mark this level. You can see right here, this candlestick, it has an upper shadow. This upper shadow signifies there wasn't a follow through. We can say it has a long upper wick. Now this upper wick shows that sellers are still interested in this breakout. So you can see how price reversed all the way down before price later continued. And again, this top right here, let's mark another break we had right here. This break right here, you can see price broke this level, but later price pushed back. That means there wasn't a follow through. Unlike the follow through we had right here, you can see after we broke out this highs here, the series of candlesticks we had gave a follow through. 1, 2, 3. So follow through. Now in the situation whereby you find the first bullish breakout, if the second candlestick after the bullish or the breakout of level reverses down, then there is no follow through. Now that is an indication of a trap, or what institutional traders use as a way to trap inexperienced traders, and this is what we call liquidity grab or liquidity sweep in trading. Yes, let's look for more examples. Here comes another example right here in this downtrend. You can see this series of tests right here. Can see price didn't break this level. The first time it wasn't a follow through. The second time price pushed all the way down. Now let's see this high again. This high we thought price would break out. You can see there wasn't a follow through. The first candlestick closed out, the second candlestick closed it down, so there wasn't a follow through. Now let's study this peak here again. Now at this peak right here, you can see there was an upper shadow candlestick. There wasn't a breakout, and later on price went out with a strong bullish candlestick. You can see the follow through. Now whenever you see upper shadow candlestick taking out or closing and having a rejection at the upper level, which should be our breakout level, and the candlestick has an upper shadow, then that is not a breakout. Don't ever treat it as a breakout, right? Because there is no follow through. Now let's study this downtrend price trend for a fake breakout to see how fake breakout actually performed right in this downtrend. First thing, right from this low, let's see how a first breakout performed. You can see that in this market structure right here, price got to this level with a small bearish candlestick, which wasn't a strong momentum candlestick, or high volume wasn't detected right here. Price reversed all the way up. Now let's carefully study what happened at this low once again. Now what is the difference between this level, this breakout candlestick you can see on the chart, this candlestick, and this right here? You can see there was a massive difference. Small bearish candlestick trying to clear out this structure as a breakout structure, but it failed. And the long candlestick, this is strong momentum bearish candlestick, it broke this level as a breakout structure. Now you can see the importance of high or strong momentum. Long candlestick is what you need to do the job. Now check out what we have right here at this low right here. You can see how price gave a lower wick at the bottom of this candlestick. It didn't break this structure. You can see price went up again before we had a strong bearish candlestick closing below that level. You can see that bearish Marubosu candlestick, which indicated a strong momentum to the downside. So this is how you filter out fake breakout from the real breakout. And then again, right here at this bottom, you can see price took out this low with a strong bearish candlestick, but there wasn't a follow through. Later on, the next candlestick gave us a doji, which means there wasn't a follow through, and later the price reverses all the way up. So there must be a strong volume candlestick and a follow through. Now check what we had right here from this low all the way down. Now carefully study the lower shadow of this candlestick. You can see right here, this is not a breakout. Price closed back, and the next two candlestick gave us a bullish candlestick. The third one, that wasn't followed through. You can see that the third one, the fourth candlestick after the two bullish candlestick, it gave us a doji that wasn't followed through. In fact, in this market, we only had the follow through on this bearish candlestick right here. Everything which occurred at this zone right here, there wasn't a follow through at this medium, not until we had this bearish candlestick before we had the follow through. So for a breakout to occur, we need a strong momentum follow through to the direction which the market is pushing to. Now here comes another example. You can see right here, you can see there wasn't a strong breakout right there, not until price got to this level right here. You can see before we had the breakout, and then the next series of candlestick gave us a follow through. You can see the organized series selling candlestick right here, which gave us a follow through. So right here is where we had our breakout structure. So this is how you dissociate a real breakout structure from a fake breakout structure. Real talk. Have you ever entered a breakout and it reversed immediately you made your entry? Let me know in the comment section. Now, risk management in trading POS. Let me be very clear. Breakout structure alone will not make you profitable. Risk management will make you profitable. Yes. Risk what you can afford to lose. Place logical stop losses. And remember, one trade does not define your journey. Professionals survive losses. Beginners chase wins. So how do we manage our risk when trading breakout structure? Trading breakout structure, we need to understand how to place our stop loss. Now let's look this trend. Let's go over it through again. Now, for instance, if we were to take this sell right here, which is a breakout structure, if we were to make a trade right here, we could have just made our entry as this breakout, or you wait for a retracement. There are two ways to make your entry. Number one is to go through the aggressive entry. After the close out of this level, which is a decisive or high momentum candlestick, then you put your stop loss, you place your entry, then you place your stop loss at the last low high swing. You can see this is the internal low high swings, and then you target a minimum of 2:1 ratio. Another way to trade this setup is to wait for price to retrace and then test this breakout structure once again. As you can see right here, after we had the break right here, price later retested this zone before it went all the way to the downside. But most time you might miss this type of trade, because not all the time price will always give a retest, but patience pays a lot. Now let's say for instance you were to make a sell right here and you place your stop loss right here all the way to this level. You could have bagged in 2.3 or 2.5:1 ratio. Right now, let's take for instance you are the patient trader and you waited for a retest. You made your entry right here and you placed your stop loss at this low high. How much would you have made? To this level right here, you would have made 5 risk to reward ratio. So it's only for the patient traders, those who are willing to exercise patience. Now let's move forward again. Let's see another example. Now in this market right here, if you are that aggressive trader, after this breakout you place your stop loss at the last low high swings right before the breakout. You target all the way down, you would have made 2 risk to reward ratio. But if you were that patient trader looking out for a retest, let's see what will happen after the breakout right here. Do we actually have a retest of this structure? No, we do not have a retest, so that means you could have missed out on this sell right here. Okay, now let's move on. Let's see another more examples in this market. And right here, you wouldn't have placed any sell right here because this was a follow through. So if you were to wait for a retest of this breakout structure right here, you could have made your entry right here, place your stop loss at this high structure. So if you were able to trail your profit as the market moves all the way down, then it's possible you might be out in break even. Or if you exercise that good patience and then you waited for a buy or a sell, rather a sell at this level right here, you could have made a nice profit on this trade, whereby you waited for price to retest this break of structural line. You can see we had the retest right here. You could have made your sell right here and then your stop loss at this level right here above the breakout, and then you target all the way down. You could have made 5 risk to reward ratio setup. So those who made their entry at this decisive breakout right here or the follow through bar and they placed their stop loss right here, they would have had a lot of drawdown when the price was retracing to test the break of structure. You can see only the patient traders can survive this massive drawdown, and there at the end of the trade you can see they had 1.6 risk to reward ratio, whereas the patient trader who waited for a retracement had almost 4.8 or 5 risk to reward ratio. This is to tell you that patience pays a lot in trading. Now this is how you make your entry if you are selling with the break of structure, or if you are selling in direction of break of structure in a downtrend market structure. Now let's look out for a bullish market structure to see how we could have bought if we were to be in a bullish market structure. Now based on what we had right here, you can see we had a break of structure right here with a strong momentum candlestick right here. This is a good example. If you were to buy right here, this is what you could have done. You place your buy right here at the instant breakout right here, because this is a momentum bullish candlestick. You can see price went deep and then instantly there was a massive rejection to the upside. So your stop loss could be at this low, and then you ride the trade maybe to this resistance structure right here, and then let's see, that would be a swing trade and for the patient trader. So there is almost 2.1 risk to reward ratio. So that is what we have in a break to the upside. And right here, if you were that trader who exercised patience after this breakout right here, in fact there wasn't a decisive breakout right there, so I wouldn't have made an entry for a buy if we were to trade in direction of this breakout right there, because we couldn't have a momentum candlestick right here or a strong volume based on what we've discussed in the previous slides, right? So that is what we had right here. So now let's move on. So let's look out for more bullish rally right here. Now based on this structure right here, we had a break of structure. If we were to take this trade right here based on this bullish candlestick, if you were to make your entry right here based on this strong volume candlestick, your stop loss could have been underneath the bullish candlestick, and then you can see we had 1 risk to reward ratio before the trade retraces all the way down. So only a smart trader could have played a defensive trade right here. So this is to tell you that the only way you can avoid unnecessary or fatal losses is to manage your risk properly in the aspect of don't risk more than you cannot afford to lose, and then be smart enough to trail your profit as the market advances upward if you are buying in a bullish breakup structure or if you are selling in a bearish breakup structure. Let me know in the comment section. Do you have a fixed risk per trade or you just freestyle it? I want to know in the comment section. Now, what are the wrong beliefs about BOS? Let's correct some dangerous minds. Not every BOS is an entry. BOS is not magic, not the Holy Grail system, and stop loss is not optional. Breakup structure is a tool, not a miracle. Now let's look at some of the breakouts which you shouldn't take. For instance, we have a break right here, and we have another swing high at this level right here. Now looking at this breakout right here, it's not a decisive breakout, even though if you were to use this first breakout right here as an entry, these are not the type of breakout you should trade, because there are a lot of factors at the top which could serve as hindrance for this buy. And you can see it did happen and price reversed all the way down. Now let's check some breakout you shouldn't take. Another example is what we have at the left side right here. Now check out this breakout right here. You can see the breakout, we didn't have a massive volume candlestick, or there wasn't momentum right here. So this type of breakout, you don't take it. You can see it didn't last long before it reversed to the downside. And again, let's check another example right here. You can see this breakout right here, it wasn't accompanied by a momentum bullish candlestick. You can see just a scanting candlestick pattern. Oh yes, so this type of breakout, you don't take them. Now this type of structure right here, see this breakout at this low here. Now this is a break right here. You can see markets moved to this level before we can say okay, there's a breakout. But this breakout right here, if you check it right here, there wasn't a momentum bearish candlestick. There isn't high volume right here, just a normal random volume. So you don't take this type of breakout. Candlestick which are long like this, long candlestick like this, these are what you take. Check this right here. You can see highs right here were being taken out at this level right here. Now check the candlestick that took out this high. You can see it has an upper shadow. These are not breakouts you should take. If you trade this, you are going to blow your account. Also, in any breakout you are trading, don't eradicate the importance of stop loss. For example, if you would like to take this breakout right here, and you can see that you are having a kind of too wide stop loss, don't take it. All right, for example, the one we had right here, there isn't volume right here, so you don't take this. So if you want to take breakout concept, always make sure you have stop loss in place. Don't say, oh, this is a strong breakout, I don't need a stop loss. You can see this candlestick right here actually closed out of this level. You can see price still went all the way low, right? It is essential. Now look at the break of this low right here through a decisive volume breakout. You can see price went down and then closed up again. So don't forget to place your stop loss. Stop loss is vital in trading, right? Comment yes or no. Did you think every breakout was an entry before now? Let me know in the comment section. Why some win, why some fail trading BOS or breakout structure? Same strategy, different result. Yes. Why? Winners are patient, disciplined, calm. Losers rush. They overtrade and react emotionally to every picture the price prints. Now, trading reveals discipline, not intelligence. No. Be honest with yourself. Which category are you in right now? Let me know in the comment section. Reliable breakout structure factors. For us to have a reliable breakout structure, a strong BOS usually has clear trend context, strong candle close, key level confluence, active session timing. When these align, your probability improves. Not guarantees, but an edge. Quick check. Do you normally trade randomly or wait for confluence in trading? Let me know in the comment section. If you don't want to trade alone, we have a free ChartsEmpire Traders Community where we share scalp signals on Gold and GBPUSD. And for traders who want more, our VIP Mentorship gives access to unlimited premium trading signals across Forex, indices, crypto, commodities, and stocks. VIP students get full access, structure, clarity, guidance. So, drop a comment. Do you prefer free signals or full VIP mentorship program? Let me know in the comment section. If this video helped you, like it, share, subscribe, share it with some serious traders who want to learn about trading. Follow ChartsEmpire on all platforms for daily market insights. And before you go, answer this. What do you want next? More beginner breakdowns or live market analysis? Let me know. I read every comment. Go through the description of this video and choose what fits your journey right now. And remember, your trading story is not over yet. I will see you in the next one. Peace.